Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have the two of you along. All right, Angie, what is cooking?
Well, today is kind of a odd day because it's February 29th. Doesn't always happen.
I don't recall having a February 29th very often.
Only every 4 years. So what I did.
Why is that?
Because it's leap year.
I got that. I've heard it called leap year. But why is it called leap year? Why are we leaping?
If you want to know the actual reason, it has to do with the Gregorian calendar, and leap year occurs every 4 years to help synchronize the calendar with the solar year, or the length of time it takes for the Earth to complete its orbit around the sun, which is about 365.25 days.
See, you just learned so much on Consider This Program.
I know.
Amanda looked at me a week or two ago and said, you know what, I want to bet with my husband, and there is no better bet. You know, because he didn't know that George Washington wasn't the first president. And because she listens to the show, she learned, won the wager.
We got all kinds of fun
We now have
facts.
Gregorian calendars, whatever in the
I'm
world
going to
that
have
is.
you guys guess these. What would you say your chances are of being born on leap day? About 1 in
I would take 365 times 4.
1,500.
That's about 365 times 4, in case you wondered.
There you go.
That would be 1,200, 240, 1,440. Yeah, it's about 1,500.
Here was an interesting question. It says, if you're born on leap year, can you get your driver's license as early as February 28th? Which when we're 16 and we can't wait to get our license, but it says, well, that they let each state to consider.
And it's an interesting phenomenon because we are seeing fewer and fewer people rush out to get their license.
Oh, I
at
know.
16.
Oh, yeah.
It is odd. I mean,
Yep.
we couldn't
I
wait.
couldn't wait.
Heck, I would have pitched a tent if
I
they would
had
have
my
let
mom
me.
take her day off work so I could go get my license.
And
but
celebrate,
kids
huh?
don't do
Yeah.
that.
No.
But it says in most states they have to wait till March 1st, but there are some states that go ahead and let them do it on the 28th.
Oh, there you go.
There are also about 187,000 people in the U.S., 4 million in the world, who were born on leap day.
My daughter was due on leap day.
Oh, was she?
Almost 20 years ago, yeah.
How much did she miss it by?
March 2nd, so about 2 days.
Yeah, 2 days. So is she now considered 5?
No, she's born
If
March
it happens
2nd.
once every 4 years. Oh, yeah, because March 2nd. Yeah.
Well, it does happen every 4 years, but not unless they can be evenly divided by 400. So there are
I didn't
some
even wanna
years
go
that
there.
it's not. Yeah.
Hey,
it's-
you're listening to Consider This Program. We really are about money. I like talking about this interesting stuff, but I want to give you things. That is my purpose in life, is to give you things you can consider that will make your financial life better. If you want to do this on your own, that is your business. If you're looking for a fiduciary, that is our business. So stick around for Consider This Program. Angie, Ken, and Joe will have things for you to consider here in a moment.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This Program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
I hate rules. I hate restrictions, but sometimes they are a necessity of life. Have you ever had a budget? I am not a fan. However, I will tell you when it's time for retirement, it is something that you may want to consider. Hi, I'm your host, Joe Clark of Consider This Program.
And I'm Angie Kinzer.
We are happy to have you along. So, Angie, you've asked me to talk about retirement budgets. I have more than openly acknowledged to as many people as I can that the last time I had a budget, not from the business side, we clearly have one of those, but for Barb and I, was when I had more month than I had money.
Okay.
Right? So I am not a budget fan. However, it is a critical part of retirement. So I will leave this to you, and you can ask your questions.
And a lot of times I always hear you mention that maintaining your standard of living is really kind of what your goal is in retirement, not what are your returns, how much do I have? All of these questions boil down to, can you maintain your standard of living? So it makes sense that a budget would be something we'd want to talk about.
So let's talk about that real quick. And I know this is not part of your agenda, but it is important to understand. So for the 40 years of your accumulating life, when you're putting money in accounts, right? We have balance sheets, we have all of those other things, right? And for 40 years of your life, you have focused on seeing what an asset value is. What's that statement say? When it's time for distribution, you have to flip a switch, and it's now about income. It's not about assets. Now, you're still going to get statements because the SEC is not going to allow me to stop sending them to you. But it really, really is about income. And I will, I'll take you through a horror story that you're going to think is obnoxious because I've memorized all these numbers. But it is what it is, right? So I had 3 people walk into my office, 3 boys walk into my office in 2002. And if you don't remember 2002, let me just help you. It was one of the world's worst period of time to retire because you're pulling money out. It was one of the worst periods of time for needing income. 2002, in my view, was technically worse than '08. It was pure market moves, but it was ugly, just pure ugly, right? So they walk in and they said, Joe, we need $2,450 a month to pay our mom. They did what was called a life annuity. It's an estate planning thing that we help people with, where they agreed to pay mom a certain amount of money for as long as she lived, right? So if she lived to be 160, we'd still be paying her.
Okay.
She actually passed away last year, right? So
how old was she?
In her 90s, but we paid her 18 years worth of income. Ooh. 17 or 18 years worth of income, okay? And I did the math, and I said, I need about $690,000 based on where we thought the market valuation was at the time. And they said, we've got $651,000. That's all we got. And so we took the 651 and we started. So the first 5 months of 2002, it was just so brutal, Angie. I just can't, I can't tell you what it felt like, but it was ugly. And they were down to about $590,000. All right. Now, the first thing you need to do listening to the show is understand how our minds work, right? When a market goes up 3 times in a row, you believe that it will go up indefinitely, right? In the late 90s and leading up to the tech wreck, I swear people were calculating the day until they'd be a billionaire, right? I mean, because it was like printing cash in the marketplace. And when you have bad periods of times, like we've experienced this week, people start to have a period of time of how long it is until they have zero, right? Neither is accurate. But, they're down to about $590,000, and we have what I call a come to Jesus meeting, right? So yes. It's the 3 brothers and it's Joe, and they're looking at me going, we can't do this. We're going to run out of money. And I'm going, listen, markets get out of whack. Just relax. Markets get out of whack. That this is not Joe telling you to hold on to something forever because markets always come back. That's not true, right? That's not at all what I'm trying to say. What I'm trying to tell you is that you have to have discipline and you have to have a philosophy that you're willing to stick with. And so what happened is they stayed in the game, and they had a balanced portfolio because we're taking income out every month, right? And in October of 2007, if it wasn't the worst day, it was the worst week. It was a market high. they've experienced huge gains because 2003 through 2007 were a phenomenal period of time to be in the market, right? So their account hadn't doubled, but it had done real well. And I apologize for the vagueness of numbers, but the SEC would be very unhappy with me if I gave you numbers. So I just wanted you to understand the story of why income and assets are two different things. Big Brother comes in, he makes me go to growth. Quite frankly, today with the assets we have under management today, I would have fired him because I knew better. But back then that was a little different story. It was 12 years ago, 13 years ago.
So the balanced portfolio has a little bit of...
It's designed to produce the income. That's what it's supposed to grow. He went to growth. The account value got not quite cut in half, but close to being cut in half between then and March of 2009. Little brother comes in May of 2009, says, Big Brother's fired, you're back in charge. And she died last year, and the account had about $15,000 more in it than what they'd originally put it in 18 years ago. But the fluctuation had been 25% on both sides of the coin, more than 25% up and 25% down to the downside. I mean, there's a difference between income and assets, and you just really have to understand that. And I know I totally messed up your entire segment of what you want to talk about.
It's okay.
So we'll keep going on this in the next one, but it's heavy on my heart. So Go ahead and ask me the first question.
Well, this is just based off of an article out of U.S. News and World Report, and it kind of gives you some things to consider on how you can get ahead of the game before you retire. So it's talking about budget and things like that. One of the questions that is asked in there is, what phase of finance or time frame should you invest in growth models, since you were kind of talking about that?
Well, so we are very agnostic to the model based on age. I don't believe that age is a function of money ever. I think need is, right? So my youngest daughter is 23. She's still in nursing school. She needs her money before I need my money, right? I'm 53. So I think people get into a quandary when they look at their age and try to look at their portfolio as opposed to looking at the economics that are around them, the volatility. And it really depends on your tax diversification. It depends on the amount you have and the amount you need in terms of income. And those things are all variances that we deal with in the next steps meeting. When somebody calls Angie and says, hey, I don't want to do this on my own anymore. I at least want a second opinion. And you come in for a next steps meeting, we're going to give you things to consider today, things you need to consider in the future. And if we choose to partner together, we're going to give you things that FEG will do for you. But there's a lot more than just a simple thought to this.
Right.
Is part
and
of the problem.
that's the thing. I mean, sometimes you'll come in and if you want to do it on your own, that's okay. I mean, but if you're looking for a fiduciary, then that is our business. So, I mean, I would come in for a meeting. You're right. The second opinion is worth it.
I think it is. But anyhow, so you're listening to Consider This Program. I am the host, Joe Clark. Angie Kinzer along with us. We talk about all things retirement to the best of our ability. We manage money for a little over 1,000 families across more than 30 states in the United States. And we're very, very honored and privileged to do that. But we would love to sit down and have a cup of coffee with you, talk a little bit about this. We'll take a break. We'll come back, and we'll talk a little bit more about retirement planning because I know Angie really wants to get these questions out. We'll be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
There are hammers, pliers, screwdrivers, all sorts of tools that are probably lurking somewhere in a drawer in your kitchen, believe it or not. Most American families tend to have one. You are listening to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
And today we're going to talk about your tools and things you
Oh.
need to understand, except this time it's probably tools that are lurking inside of your 401k. Angie.
Oh,
So when you open up your 401k and there's choices where you can put money, you're going to hear words like large cap, mid cap, small cap, global,
yes.
right? And so we got to ask some questions, and so now I'm here to answer. So
Well, I mean, a very basic question is, what is the difference between those three classes of small, mid, and large?
So anytime you hear the word cap, market cap, it stands for market capitalization. And there's a very simple formula. It's one share of a company stock times the current price times the number of outstanding shares. And so when you look at a company like the Financial Enhancement Group, for instance, right, we're not publicly traded, but I've got 4 partners, right? There are 100 shares, right? So they own some of the 100 shares, right? Microsoft has, I believe to date, over 10 billion shares of stock outstanding. Harley-Davidson has about 300 million shares of stock outstanding, right? So the number of shares that you have or the current share price mean nothing without those two being brought in together. And so large cap simply means it's the largest of companies that are out there based on capitalization. When I got into the industry back in 1987, those were companies over $5 billion of market cap. Today, Apple's topped $1 trillion of market cap, right? So it's the last time I saw the percentage breakdown, about 18% of the companies in the United States that are publicly traded qualify as large cap, and yet 68% of mutual funds are large cap. Right, so it's a little that's part of the problem. But the difference is just in the size in terms of market capitalization. Typically, a large cap stock will be less volatile than a mid cap or a small cap, but that's not always true.
Which would be more liquid?
Liquidity is not going to get in there. In the equity world, when you talk about liquidity, you're talking about volume, and it's the number of shares that are traded on a daily basis. So typically, a company that has 10 billion shares of stock outstanding versus 300 million is going to have more volume. So by definition, it would be more liquid. But the one thing you can never do as an investor is confuse yourself with the economy, the company, and the market, right? There is a huge difference between the stock price and the difference between, what's going on in that actual company. Stock prices go up and down all the time, even though sometimes companies do stupid things and their stock goes up. And sometimes companies do brilliant things and their stock price goes down, and it's more reflective of what's going on in the market necessarily than it is what they're doing individually.
You talked about, the differences, and maybe volatility is one of them. What about costly? Which is more costly to own?
Well, when you're buying an individual stock in the world of free stock trades, right? TD Ameritrade, where we custody our money, is free. Schwab, where we're probably heading because they're buying TD Ameritrade, the trading cost is free. Fidelity's got some trading costs that are free. So there's not necessarily a cost to making the acquisition anymore. And if you're working with a broker where you're buying stocks and you're paying commissions, you probably ought to be moving along. I mean, that ship has sailed, right? And the fiduciary focus, the 4 things we watch and pay attention to are risk and volatility, fees and expenses, taxes today and tomorrow, and real return. And remember, 92% of you in Indiana are your own fiduciaries, right? So if that's the case, if you're doing this on your own and you're being your own fiduciary, one of those things that you've got to pay attention to are fees and expenses to make sure that you're in good order.
Okay. As a rule of thumb, and the only reason I'm asking these questions is because going through this article that I got when I did a little bit of research on this, I saw, volatility, liquidity, and as a rule of thumb, is the performance better on one than another? Or?
Well, so performance at any given time is always relative. Come on, Ken Dilger in the house. Come on, Ken. You can come step on up to the mic, and we'll have Angie ask you some of these questions. From a volatility standpoint, typically the smaller companies are more volatile than the larger companies, typically, and they also have a period where they have greater returns in part of the market cycle.
Okay.
Now, where you are in an economic cycle can be a debatable issue, but those are fights all the time. Large cap has clearly owned, the two things that have been very, very clear in the global economic world from a stock market perspective since the bottom of '09 is U.S. has trumped everybody else, and large cap has trumped everything else, and growth inside of the large cap has trumped everything else.
Okay, so another question I have is, how does phase of finance correlate to your holdings or what you own?
Well, I'll have to structure this. So when Angie says phase of finance, Ken, here's the deal. And welcome, by the way, buddy.
Good morning.
When we talk about phase of finance, you go through 3 phases of finance in your life. Now, Ken, because he played in the NFLs, was a little bit different. His income was front-loaded, where most of ours is loaded over a different period of time. But we go through 3 phases of finance. So you go through a period of time where you're in accumulation, where you're putting money into accounts, and you have 2 goals. So
Don't lose it.
no,
Is that one of them?
not yet.
That's number 2.
But that's funny. The 2 goals are building tax diversification. So you want money that's in a Roth, you want money that is tax deferred, and you want some money that's after tax. Eventually, what you're saving today doesn't matter as much as what you've already saved. Right? So you're adding money to your 401k this year, but it doesn't matter near as much as what you've already accumulated in your IRA and retirement accounts, right? That's when you go into a period of time called preservation. And that's the only time that average return matters. So do not ever allow yourself to get in a conversation where you're talking about retirement and somebody brings up average return. You have my permission just to be rude and leave. Right? I mean, they do not understand math, or they're pandering to things that you want to hear, as opposed to the reality of how the markets actually work. So once you go from preservation, then you go into distribution. And Angie, distribution is where we want to replace our standard of living. Right? It's not about income. It's not about replacing our income. It's about replacing our standard of living. So if we made $10,000 a month and we only need 5, it's replacing the 5, not the 10, right? It's not a percentage of the 10. That's horse.
So I guess the question is in each of those different phases of finance, you might own different types of holdings.
You could, but it's in our mind, it's more of a different model. So when you go into distribution, the 2 objectives are reducing the tax rate you pay on the average dollar that you earn, that you have to take out, and secondly, then, is the amount of volatility between distribution points. Right, so when you're at that point where you're taking money out, you can expect us to have more in cash. You can expect us to have more. A lady called earlier this week and said, how are things looking? Because the coronavirus is obviously an issue, and it popped up. And, we're 10% in cash, right? So in one model, we're at over 27% in cash. So we're kind of insulated from this to a degree. It doesn't mean statements won't necessarily go down.
I saw this morning too, because we did a whole show on precious metals once, because that's not something that makes sense all the time. But I saw where it said gold was up today because of this whole thing.
Yeah, and whether it stays that way or not is a whole different story. Here's the deal. Give Angie a call.
Hey, you guys, if you want to do this on your own, that's your business. But if you're looking for a fiduciary, that's our business. Give me a call at 1-800-928-4001.
We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Rules change and they give you more opportunities, but the question is, should you? Yes, you can always choose to eat ice cream and not the broccoli. And it may feel really good at the moment. The question is, how will you feel later on? Hey, I'm Joe Clark. You're listening to Consider This Program.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you guys along.
Yes.
All right, Angie, what's the question?
The question, this is about IRA contributions, because the article is you can now make IRA contributions at any age, but should you?
So the Secure Act. So let's just break this down. The Secure Act passed December 20th. Mm-hmm. One of those things that it allowed for was the ability at any age for you to contribute to an IRA, provided you had earned income. Right. So in the past, Ken, when you got to 70 and a half, you could no longer contribute to IRAs, to any IRA. So there really are three IRAs that are out there. Now, CPAs will tell you that's not accurate, but there really are three. One is a Roth. We pay the taxes today on the money we're putting in it, in what we would call a contribution, but we never have to pay the taxes when we pull it out. The second IRA is either deductible or non-deductible. So I call it two different ones, right? It's deductible if you meet the qualifications, right? And the qualifications are you have to have earned income and you have to have a limited amount of income. You can make too much to qualify. And if you actually have a 401k or a retirement plan at work, that even makes the restrictions even further, right? So that's the deductible IRA. But anybody, even if you made $1 billion a year, if you had earned income, and you were under 70 and a half, you qualified to be able to contribute money to a non-deductible IRA. Now, why would you do that? I've done it every year since 2007. Why would that be? Because I created, and I'm sure I wasn't the only one, but if you go back and look at a lot of the original writing, it was mine. Again, I'm a tax junkie, and I've been working with Ed Slott for a long time. I wrote it for his newsletter. But we created a concept called the backdoor Roth IRA, where you put money into a non-deductible IRA, and then you're able to convert it to a Roth IRA. Now, there's all sorts of issues called the pro rata rule that we can't go into right now, but don't do this at home, right? So you always need a financial. You need somebody who understands this and the rules. So be very, very careful. But I put money into a non-deductible IRA every year for Barb and I, and then I convert it to a Roth IRA. So there you go. So when somebody was working, Angie, and they were 72, and they had to take money out of their IRA, right, because of required minimum distributions, and they couldn't contribute to a Roth IRA.
Okay.
Under the change that came out of the act in 2017, if you had a 401k and you were not a majority owner, meaning you owned less than 5% of the company, you actually could put money in the 401k if you were 85 and still working. And so the rule change in the Secure Act kind of evened up, if you will, the IRAs and non-IRA. So yes, you can.
And that's kind of relevant to, we've mentioned before that some believe that people are working longer and longer. So that was actually my other question is, can you still contribute after age 72 since people are working longer today?
And the answer is yes.
Now, what are the rules for earned income? I mean, what's considered earned income and what is not?
Typically, it's anything that you're going to pay Social Security tax on. So remember, we have essentially two structures of tax. We have and this is where you get into some of these political challenges. When you have, Ken, you'll hear people say that over 50% of America doesn't pay taxes. Mm-hmm. That is both true and false.
Right.
They don't pay taxes at the marginal rate. So when I talk about the stair steps and everything else, between credits and standard deductions and everything else, it is about 50% of America who never pays one dime of tax at the marginal rate. That doesn't mean that they don't pay tax on Social Security and unemployment tax. So you have 7.65% of what comes out of your check every week, or every 2 weeks, whenever we pay you, that I put in 7.65, you put in 7.65, so it's 15.3%. So to say that you don't pay taxes if you're a working person is inaccurate, right? and especially if you're a young person and money's being confiscated out of your check on a every 2 week period of time, it becomes very confusing. And then they get a big check back in April and they wonder, wow, what happened? Wow, right? I hit the jackpot. And so we try to help people figure that part out. But it's essentially anytime you're paying into Social Security, that's deemed an earned income. So typically rent's not, farm income's not, pensions are not, Social Security is not. You have to do something, sweat on the brow.
Okay. Should you be making IRA contributions or contributing to a taxable account instead?
It really, really, really depends. We're going to spend a lot of time. I just spent 2 people to Ed Slott's training, Grant and Solomon and Aaron Rayom, our director of financial planning. Just got back from San Francisco, and the whole mission was to understand qualified charitable distributions and what happens between 70 and a half and 72. There is no more of a no-brainer in my mind in the tax code than doing a QCD and you're over 70 and a half. Whether or not you should contribute to an IRA while doing that is a whole nother story. And it's more than I can really go into on one radio segment because it doesn't pertain to the majority of you. I will just tell you that you're going to want to get good counsel and good advice on that. If it's not simple enough for me to answer on the radio, it's not simple enough for most of the people that you're dealing with to actually understand the rules. I mean, there are some complexities that are there.
What about like a 401k? What if you have an employer that matches you up to a certain amount? Once you reach that, do you suggest that people keep contributing there, or should you try to open a Roth?
So that's a whole other question, and it really gets into that uniqueness that where we all reside, right? I mean, God made us all differently. And so I would look to see if you had tax diversification, if your money was equally divided in 3 parts between tax deferred, tax free, and after tax. Then we look at it from that. We look at your 401k to see what the investment options are inside of it, what the expenses are. Most 401ks are reasonably priced, but we still see insurance companies out there that have there's 401ks that have names of famous politicians, let's just say, and people are paying a fortune inside of their fees and expenses that would have disappeared with the fiduciary rule, which hasn't happened yet. But so it's not as simple as yay or nay. Sorry.
Well, you talked about the backdoor Roth. What is the catch-up provision?
The catch-up provision is because we're over 50. Oh, I shouldn't say that about you. Angie
You're telling my age.
Angie and I may have graduated from high school the same year, and never mind. Anyhow, if you're under 50, you can put $5,000 or $6,000 a year into an IRA. If you're over 50, you can put in $7,000. It's a catch-up provision. If you're under 50, you can put $18,000 and change in a 401k. If you're over 50, you can put $25,000 a year, something like that. I don't have to mess with those individualized numbers. We have people that are 401k experts that do all that, but that's what that catch-up provision is. It used to be one inside of the 403b world, whereas a teacher, and they were one of the few people who could go back in and over contribute to their 403b, their final couple of years of working, to get caught up for years when they may have not had the income to be able to go past. Mm-hmm. So Ken, from you on a mortgage side, if you see a teacher's income go down dramatically, yet they're still teaching, they're probably playing with that catch-up provision.
Gotcha.
Hey, you're listening to Consider This Program. I am your host, Joe Clark. You want to do this on your own? That is your business. God bless. You're looking for a fiduciary? That's our business. Give us a call.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
All assets transfer, hopefully, to your beneficiaries, to who you want them to go to, not your ex-son-in-law, not the IRS. Hopefully, they get to where you want them to go in the least amount of expense and problems that you can. Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Inheriting an IRA, Angie tells me, is the topic here.
Yes.
So things have changed, obviously, with the Secure Act. It was signed December 20th, right at the end of last year, out of the blue, by the way. Nobody wants to know how the sausage is made, but just in case you do, Congress had passed the Secure Act way back earlier in the year, May, June, somewhere in that. Senate hadn't got around to it because they're not going to agree on anything. And in a joint partisan bill to be able to get the government funded, the Secure Act was put in at the 12th hour in that legislation and became effective January 1st of 2020. Amazing that you can change rules that quickly, but they did. So what would you like to know, Angie?
Well, one of the questions we've had before is about RMDs. So a question is, can the RMD calculation be reset when a successor beneficiary inherits an inherited IRA?
Okay, so what happened? Let's break this down because we really have three types of people that are listening. We have the people who are listening who are confused,
Okay.
who don't know that anything happened, right?
And don't feel bad if you're part of that.
We still had a
Right.
wonderful lady who came in. I've been writing the newspaper column for 20 years, and she came in last week, and she said, Joe, I love your column. I read them all the time, and I know I have to start my required minimum distribution at 70 and a half. And I said, well, I appreciate you reading the newspaper column, and I'm glad you've learned that, but you've missed the last two because I've written about what happens now. It's at age 72. So we have people out there that are confused, that forget that the rules change, and I'm going to go on a wild tangent about my boot here in a minute, because that's what I wrote the newspaper column about last week. So you have people that are confused. The second group you have are people who have already inherited an IRA. So if there are two types of beneficiaries, Ken. There's you,
Mm-hmm.
and there's and your spouse,
Right.
and there's not your spouse, right? So they call them non-spousal beneficiaries.
Okay.
It's very
Easy
complex,
enough.
right? It's very complex. So as a spouse can always roll her or his 401k or IRA into their name. Okay, still can. Nothing changed with that act December 20th with the Secure Act. In the past, if you were under 70 and a half as the owner, so it's Ken's IRA and Ken Croaks, he's under 70 and a half. He dies. Your wife can roll it into her own IRA as a spousal IRA.
Okay.
If you left it to your kids, they could roll it into an inherited IRA, and because you were under 70 and a half, they actually get to take the money out over their life expectancy. Now, since you're still with us and alive today, that means you didn't die in 2019.
True.
We're now in 2020, where
Any rules changes?
the rules changed. Now, and this is very, very important to understand, now your kids have to empty. Spouses still get the same rules, right? They can roll it into whatever they want. But the spouse or the non-spouse, anybody else, has 10 years to empty the account. So there's a lot of people like me who've done very, very complex planning, right? So think about it. You've got one kid in high school and one in college, right? Their income right now is very, very low, but in 10 years, hopefully it's higher. They're doing
Right.
better, right? And all of a sudden, Ken dies on time, right? And it's your life expectancy, and you're 84 and a half, and you croak, and they're 50, right? And all of a sudden, they've got to take money out of an IRA at their highest tax, their highest earning years, right? I mean, it's really, really, really sad and frustrating. I will tell you, as a planner, I'm not happy that kids who are trying to build their own retirement, their own accumulation phase, are going to be stuck with having to pull $1 million out of an IRA and pay taxes on it all at one time, right? So what you're going to want are strategies where that money is paid out over the 10-year period as opposed to over 1 year. But that's the rule that's changed. So if you already had inherited an IRA before December 31st of 2019, nothing changed. If you were a spouse, nothing changed. If you were anybody else, with the exception of chronically ill, disabled children, minors, people that are within 10 years of the age of the beneficiary, with the exception of everybody else, everything changed.
One question that I got says, can you combine IRA accounts that are inherited from the same individual?
Ooh.
I know. And so I tried to look that up, and the only thing I could find is it says you can, as long as RMDs are calculated using the same life expectancy factor.
Because it depends how the beneficiary was originally titled, whether it was a what I call a living, breathing person. The IRS uses the word designated beneficiary. But if you have an inherited IRA and it's from the same person and you are the sole beneficiary, my guess is you could probably put those together and be okay. I would, and that's why I'm part of Ed Slott's group. You know, I've got 380 friends that are CPAs, tax attorneys, and geeks like me. We spend 6 days a year together every year, twice, 3 days each time, where we do nothing but read tax code and look at this stuff to be able to put it together. And
so maybe that's a question you could ask.
It is certainly one that I would ask. I haven't seen it happen before. And I would tell you, the person who left the IRA behind, guys, when the older you get, the more simple you want stuff, right? I mean, we work very, very hard to simplify the number of accounts that people own. I mean, we have people come in that'll have 15 accounts, and you're 67 years old, and I'm looking at it, I'm going, why would you have, you know, and the idea is diversification. They think they're safer that way, and what they really are is more confused that way. You know, and so we were able to get down in one case, we were able to get down to 3 accounts. You know, they had a trust account, an IRA, and a Roth, as opposed to 15 to 17 different accounts that they had across the spectrum.
You mentioned titling. So how should you title an IRA if there are successor beneficiaries, either spouse or non-spouse? Is there a certain way that you title?
Yeah, each custodian has their own. So if I kick the bucket, you would have an inherited IRA, from Joseph A. Clark for the benefit of Angie Kinzer.
Yes.
And then the date of my death.
Okay.
Right. So all of that is on a legal titling. You know, it's important that you get it right. But Ken, here's where people really, really make mistakes with inherited IRAs.
Okay.
Right. You've heard me say that all money is not equal.
Correct.
Right. So if you walked into my office and said, Joe, I have $2 million, well, that's a beautiful thing, but I'm going to ask you where the $2 million is, because if it's $2 million in a 401k versus $2 million in a checking account that you've already paid taxes on, there's about a 30% difference between the two, right? They both have the $2 million number, right? But not all money is created equally. And we had a case last year. It's why we worked so hard to work with the beneficiaries. It wasn't last year. It's probably 4 years ago now. But the father that I'd taken care of for over 25 years dies. Daughter inherits the IRA and the brokerage account, right? So the custodians are responsible to send out a letter once they knew that dad had died to say, hey, this is your IRA. Now, we've got that fixed so that they would have never even known that would have happened, so we could have taken care of them now. But bottom line is the son-in-law, right? It's always the in-laws, right? Son-in-law has a great idea. Let's take the money out of the IRA and pay off the house. So they had the money to pay off the house in the joint account, but he didn't pay attention to the taxes. He just simply took the money out of the IRA, said, send me a check. Once it comes out of an inherited IRA, there's no backsies. There is no, I can't fix this. And he was livid with me for not being able to fix it. I'm going, I didn't do,
So what was the penalty?
I didn't create the full taxation. No penalty. In inherited IRA, there's no 10% penalty because you have to take money out.
Tax at your current income
just
level?
Tax, but all of it, right? So they made, a little over $100,000 a year. So they were in the 22% bracket.
Mm-hmm.
Back then, 24% bracket, and added $218,000 on top of it. That was taxed at 24 and 28%, I think it was. Beautiful, beautiful moment in their lives, right? And nothing I could do about it. Hey, give us a call, 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Estate planning's one of those biggies. We are all going to eventually leave this planet. And when that happens, you want your money to go who you want it to with the least amount of cost and stress possible. Welcome to Consider This Program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
Happy to have you all along. All right, Angie. She is all things Consider This Program, by the way. If you got a question or comment you want to hear on the radio, you can give her a call at 800-928-4001. She's also responsible for our Next Steps program.
Yes. The next steps are, if you would like to come in for a Next Steps meeting and you want to give me a call, we can. Our promise is that we will give you things to consider today, things that you can consider in the future, and if we choose to partner together, then we will provide for you in writing what we think the best plan would be.
And we do that for people every single week. In fact, Angie, right before she came in to do the radio show, was working with two different families.
Yes, I had two calls back to back, so I was almost late coming in.
Yeah, tardy is what we would call that.
A little bit tardy.
But for good reason. We love to take care of people. All right, so go ahead with your questions.
Okie doke. This is about the most pressing questions about estate planning. So I thought I could give you the questions that they have in here, and then maybe you could elaborate a little. So, question number 1, if I don't have any money, then do I still need a plan?
If you have less than a certain amount, depending on what state you're listening in, and this is in 30 different states, so I've got to be careful. But depending on the amount that you have, in Indiana, it used to be, I think, $40,000, then $50,000. Somebody told me the other day it was $60,000. I'm not for sure. But if you have less than a certain amount of assets in your name, you don't have to go through the probate process. Right, so there's two different things that are at work when you pass away. One is the process of paying the state and federal estate tax. So in Indiana, Ken, we have no inheritance tax, right? So
Correct.
Used to, it followed the bloodline, right? So if you left money to your wife, there was no taxes. If you left money to your kids, there'd be a little bit of taxes. And if you left money to your nieces and nephew, there'd be a little bit more. And the neighbor boy down the street would be even more, right?
Gotcha.
That's all gone. So there is no inheritance tax in Indiana anymore. The federal estate tax, up until the end of 2025, we've got about $11.5 million a piece that we can leave behind. So you and Heidi have $23 million between the two of you that you can transfer to your kids and pay no estate tax to the federal government, and obviously none here in Indiana, being an Indiana resident. But the second part then is the expense of actually transferring those assets from one generation to the next, and that's probate. It has nothing to do with tax. It's legal expense. Right, it's the problem of getting it all sorted out. And so if you have very little left in your name, then it doesn't matter. But you can use the operation of law things, Angie, like the TOD, transfer on death, payable on death, beneficiary designations. The state of Indiana now allows for a thing called a ladybird deed, where you can put a beneficiary on a home to be able to keep it out of probate. So there's things you can do.
Question number 2: What keeps me awake at night isn't my money. It's worrying about my family and the impact the inheritance I leave them will have on them. Any suggestions?
I say with a big cup of coffee, a big drink of coffee in my mouth. It concerns me greatly as well. If there's anything that I think middle America fails on in a continual basis, it's that we don't talk to our kids about our money. Right. One of the conversations we're going to have on Consider This Program in a couple of weeks is how to talk to your mom and dad about their retirement. To asking the questions that you need to ask. So, I make no bones about it. I've used my mom's tax return. I've used my kids' tax returns. To position assets and to do things. If I'm going to make a gift, I want to know where it's, how it's going. But I think one of the mistakes that I see happen a lot is, we have, probably more than $100 million plus IRAs. All right, so you have two kids, and all of a sudden somebody's going to get a kid's going to get a $500,000 check that knows nothing about investing, knows nothing about money, and it's just because you die. And that concerns me greatly. So we work very, very hard. I do it with my own kids. I give them money every year for Christmas to put into Roth IRAs. They have income. They just don't have any money to put in the Roth IRAs, right? Mm-hmm. So I give them money. I teach them the concept of matching. If they put money in, they get more money. But I want them to understand how investments work. And, it's one thing for them to say, well, Dad does this. And, well, Dad's not going to be here forever, right? So I'm very, very concerned with that. So my trust has it laid out so that if something happened to me, they don't get a bunch of money all at one time where they have no experience and no education. But I'm also trying to counter that by giving them education along the way. They get the famous pop quizzes.
Oh, I hate those pop quizzes.
I can't imagine. It must be really rough having me as a dad some days.
Well, my grandfather was a mathematician. He was a college professor, and I always dreaded going to his house because they were always story problems. If there was a train going 45 miles to an hour, and I would run from
That's how they think. So we went up to the museum in Chicago, and I love that place. There's a U-boat, right? And so I found out my daughters went to a Christian school. Kendra actually graduated from LaPel, but went to a Christian school here in town. And it appears that they kind of removed history to put in Bible. Now, I'm very, very thankful that they had Bible education, but they didn't have history. And so, I'm tooling down the road. I'm all excited about there being a U-boat at the museum that we're going to. And I asked them about World War II. They have no idea who was in World War II. I played out the countries, and they had no idea whether it was, the axis of evil or whether it was part of what's now NATO, our allies. And then when we got down in the museum and I saw the Enigma, oh boy, then I was a really, really happy camper. And they might have had a 35-minute dissertation on what the Enigma was and why it was so important. And if you don't know, Amanda, so you can win your bet, if you don't know what an Enigma is, it was a German math machine that they had figured out to encode messages that we would have never figured out. The number of codes that they could put in were just unimaginable. And that's why they would scuttle ships, because they had Enigmas on them. And the German boats did, the U-boats. And so we finally got one of the U-boats, got an Enigma. They didn't know we had the Enigma. We made it look like the Enigma sunk. And then we were able to baffle it. And other than that,
great plan.
Other than that, it was the Navajo. It was the Navajo Indians. And if you haven't watched Code Breakers, it's a great show to watch. And yes, I am a geek. I do appreciate all the people who went before me. And so we did spend this weekend watching Midway, by the way, which is another good movie. 2 thumbs up. You should watch it as well.
Okay.
Back to money.
Well, back to some of the questions commonly plaguing people about estate planning. Do I really need an attorney to draft a will?
Yes.
Okay. That was quick.
Do you really need one? No, but the cost anymore of getting it done, and I shouldn't even say that. No, I backsies on that. You want to make sure that you get this right. I mean, you really, really do. And so there's some key things that have to happen in the last will and testament. Revocation of any other ones you made before you. You need to do it in a closed room. It needs to be witnessed. There's things that you just need to have in there that make sure you don't get wrong. But it's not that expensive anymore. If you have a basic will, just get it done, right? Just do it. Hey, you're listening to Consider This program. We talk about all things, including Midway and Enigmas. But we're happy to answer your questions, too. 800-928-4001.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
I'm Ken Dilger.
And I'm Angie Kinzer.
And Angie has a A subject.
A subject. Yes, I always like to find these things and then ask you guys about it and see if you agree or disagree.
Why do I feel like she's trying to set us up again?
She must know something we don't. That's why she's asking the questions.
Well, this is a list of things we all buy but don't need to.
Hey.
But you might agree or disagree. So number 1 on the list is extended warranties. With every product.
Ken?
I bought one for my wife's car 7 years ago, and I regret doing it.
Never, not once. But that's because I'm in the financial world, and I know exactly how profitable those things are.
True.
Well, a lot of times that you're buying something that's less than $150 and the price on it's $40 for the extended warranty. So it's really a question of, can you go out and replace it if something really were to happen to it? So, but most people get caught by those.
Yep. Never, not once.
Now, I was surprised. Look what made the list at number 2. Expensive mutual funds.
Oh.
That's Joe's favorite, right?
Yeah. Being that I've never owned a mutual fund, never sold a mutual fund, I guess we'd have to say I've not had to experience that.
Okay. The next one on the list was cell phone extras or paid apps. Like.
Well, now these are fighting words. So go ahead, Ken.
Boy, I can't remember the last app I paid for.
Right, because most of them are free.
You know, even if it's $1 or $2 or whatever, I don't buy it. I'm like, yeah, I don't need it.
Wow. My most expensive app, I probably have 50 of them that I pay for a year.
Really?
So when I taught at Purdue, and what I learned as a certified financial planner calculator-wise was HP 12C. It was Hewlett-Packard calculator. It was $110 a piece. And Hewlett-Packard's infinite wisdom, they quit doing it. I think it's called the 12E calculator on my.
Oh.
It was $24.95 one time, right?
Did you buy the extended warranty?
No. And I can text you not just the answer to the math question that you asked, but the keystrokes that I used. So,
interesting.
I mean, it's great. DPY Yoga is one of my apps that's on there. I've got all sorts of research apps that I have to pay for that come across, but it's, I work on my iPad. I mean, anybody who knows I run the company pretty much from an iPad. So they're not fun thingies.
So you've got a yoga app. I have a fantasy football app.
Yes, I have a yoga app. I actually
you paid for it?
No.
I probably have 3 yoga apps if you want to know the truth. All right, give me the next one.
The last one is rental car insurance. A lot of people get caught up in that.
Well, yeah, because they don't know that their current home or current auto insurance will probably cover most things that they get into.
Absolutely. Never buy it. Just say, nope. You're usually covered at least 3 times. Usually the credit card you used has something attached to it.
Yeah.
If you've got one of the top credit cards, and your own car insurance will take care of it. So very good, Angie. I like the conversation. Hey, I hope you enjoyed the show today on Consider This Program. You got a question or comment, give Angie a call at 800-928-4001. Have a great week.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800